All right, let's take a deeper dive into the Fed Chair Powell's testimony before Congress, what it means and why it matters for everyday Americans. Joining us now is Michael Gapen, Bank of America Head of U.S. Economics, and Troy Gayeski, Chief Market Strategist at FS Investments. Michael, we'll start with you. And your biggest takeaway from Powell's testimony today?
I think it's a pretty straightforward takeaway, which is the door is open for a faster pace of rate hikes or the return to a 50 basis point hike in March. But will the data walk through? Right. That's essentially it. He said if the totality of the data justifies a faster pace, we'll certainly deliver that. And as you just mentioned, there's a series of data points between now and March 22nd, including JOLTS, the employment report, CPI, PPI, retail sales. So there's enough there that if it clears the proverbial bar, the Fed will switch back to 50. If the data softens up, the Fed will likely do 25. So I do think it is dependent on what's before us between now and March 22nd. I'm not sure it's penciled in firmly just yet, but certainly Powell left the door open for it. And if the data walks through, the Fed will respond. That's my main takeaway from today.
So, Troy, break all of this down for us, the investor out there, why they should care so much about what Powell had to say in front of lawmakers today, and then the top trades from an environment like this, that higher for longer interest rates that Powell has been talking about time and time again.
Yes. So bottom line is, investors continue to pine for the days of 2009 to 2021, where, every time there was a problem, the Fed had ride to the rescue with lower rates and more quantitative easing. And, Powell reminded everyone today that, look, if you're buying equities in the S&P at 18 and a half times forward earnings, based on 23 rather paltry earnings estimates, you're playing with fire because we're in a much more sustained inflationary environment. Obviously, they're going to hike more in the front end, more than likely 75 basis points, but they have left the door open to more. And they're still tightening the balance sheet and draining money supply. So we're just in a very different investment environment than, 09 to 21. We're not going back to those days anytime soon. So in general, as an investor, you want to focus on protecting capital, take less risk, maturely accept low returns, somewhere in the mid to high single digits, and make sure you don't get carried away with bear market rallies, particularly chasing them. And then in terms of top ideas, look, it depends on the strategy. Alternatives are now democratized, so you can do things like senior secured commercial real estate debt. You can embrace daily liquid multi-strategy solutions that have that, what we refer to as Northwest Quadrant efficient frontier return profile. But if you're going to have to take risk and embrace more volatility, then you should do it in securities that throw off a tremendous amount of income, whether you look at mortgage REITs or you look at listed BDCs that trade at significant discounts to NAV. When you're earning a 13, 14, 17% dividend yield, you can stomach a lot of volatility, but you will have volatility and there will more likely be more downside in price. And then secondarily, look, if you look medium to long term, one of the few things you can be confident in the next 5 to 7 years is we'll continue to underinvest in commodity production and energy production. And so that creates a higher floor for the commodity complex. We're much less confident in demand, particularly in the short term. But if you have a longer time horizon, that's a sector that one could focus on as well.
Okay, and Michael, to the narrative that we alluded to about the labor market, I laid out two options, and I think Seana laid out a third. And one is they just wanted Jerome Powell to say 2 million Americans need to lose their jobs for 2% inflation, or they don't understand the labor market, or three, we can get there without a dramatic spike in the unemployment rate. Which is the case?
So we would be surprised if we got inflation all the way down to 2% without removing some of the imbalances in the labor market. History does suggest that the amount of disinflation that we're looking for would require some softening in the labor market and some rise in the unemployment rate. How much, of course, remains to be seen. Most of us are thinking a moderate rise in the unemployment rate. So we have it rising to 4.7 or 4.8%. That's still well below what would be a 30-year average unemployment rate. But there's a big persistent imbalance between labor demand and labor supply, and that is one of the factors helping to keep inflation elevated. So we come down on that side of it, but the pandemic is a very different cycle. It's not inconceivable that inflation could fall more rapidly without needing to lean on labor markets heavily. I would just be surprised if that were the case. So I can't rule it out, but I think history tells us some softening in the labor market is likely in store.
Troy, what do you think?
Yeah, so look, 3% should probably be the Fed's new target, but they're still stuck on 2%. It is unlikely that unemployment doesn't go up, at least materially. But yeah, that 4.5 to 5 range makes a lot of sense. But again, if you think of the big picture here, the big picture is, the labor market continues to do exceptionally well. The nominal GDP continues to grow at a very rapid rate, while financial assets are taken on the chin, which is really a complete reversal to the days of quantitative easing. And the term we have for it is galactic mean reversion, where not only do financial assets struggle, but you still have a remarkably stable labor market. And the silver lining from the pain that's been taken in financial assets more recently after a bear market rally in late October and early January is that the longer the labor market remains resilient, you keep pushing back in recession risk, and it allows the Fed to have time to gradually at least bend it down to 4 to 3. Whereas if instead we were headed for a hard landing, that would create much more labor market pain. And so it's really a great time to be a worker and not as good of a time to be long only equities and long only fixed income.
So Michael Powell did say that the path to lower inflation is likely going to be bumpy. Your best guess is a scenario here at the end of the year. What do you think that inflation level will likely look like?
I think somewhere, our forecast would have it a little above 3%. So let's just say 3 to 3.25, around 3.25 by the end of the year in terms of what the year-on-year rate of inflation would be at the end of this year. But just remember, we're still in the mild recession camp. So we still think later this year, the economy would slip into something that looks like a traditional recession, and that weakness in demand would be one of the factors helping to bring inflation down. In a soft landing forecast, it may be that inflation stays firmer for longer. But to answer your question, something a little above 3% is where we think we're headed by the end of 23.
All right, Michael Gapen, always great to have you. Troy Gayeski, you too, thanks so much for joining us here to break down the latest comments that we're getting here from Powell.